It's the battle royale between the bulls and the bears. That's coming up on 3 Minutes on Markets and Money. On realinvestmentadvice.com this weekend, we posted the newsletter. The battle between the bulls and the bears ensues. Just click the newsletter link at the top of the website. You can download the whole report, but we lay out the bullish case and the bearish case, talking about the markets. On the short-term basis, markets are very bullish. The 20-day crossing above the 50-day moving average, providing that running kind of trend support for prices in the short term. Markets set to test the 200-day moving average. A break above that level really starts to bring all-time highs back into focus. Now, that's hard to believe with the inflation rate still at 8.5% and economic data weak, and we've got markets doing this well. Of course, now there's certainly some levels of support here, and an expectation that markets could correct a bit in the short term is certainly logical. So a correction back to the 100-day moving average, then the 20, potentially the 50, all good levels of support for this market. And that would provide you an opportunity to add some exposure to portfolios. And again, that seems a little bit weird considering the economic weakness that's going on and the Fed hiking rates. But look, markets are markets and they tend to lead the economy versus lag. So maybe the market's telling us that the worst of the economic downdraft is behind us. Don't know. It's way too early to tell that. If we can get this market to continue this advance, a pullback to support certainly provides a good opportunity to add some exposure short term, as I said. But importantly, markets are very overbought on multiple levels. And again, that suggests that we do get some type of corrective action over the next couple of weeks. That, again, we'll have to reevaluate where that goes to. If markets completely crash back through the 50-day moving average, we're going to test new lows and, of course, be looking to set new lows. What could cause that? A pickup in economic data that is weaker than expected, the Fed being more aggressive than expected come their meeting in September. Expectations right now are that the Fed will only hike 50 basis points, and that will likely be the end of it. If the Fed comes out at the Jackson Hole Summit at the end of this month and says we're nowhere close to finishing hiking rates and are more aggressive in September, that could certainly begin to weigh back on stock prices again, because this whole rally has been predicated on this idea that the Fed is almost done hiking rates and closer to a pivot. Look, economically speaking, the data remains very weak, and the bearish case is that the Fed is not close to the end of rate hikes and are going to have to remain aggressive to combat 8.5% inflation, which is not going to come down quickly through the course of this year. Furthermore, they're certainly not reducing their quantitative tightening at $95 billion a month. They're extracting a good amount of liquidity from the markets. That's been one of the primary drivers of asset prices over the last 12 years. So again, the bears also have a very good point here that the liquidity flows and the extraction of liquidity and monetary policy from the market is going to weigh on prices, particularly with valuations still running at 30 times earnings on a trailing basis and earnings being reduced on a forward basis, and particularly profit margins because of high inflation. So again, the battle between the bulls and the bears are certainly worth noting. Again, short term, very bullish for the markets. Longer term, certainly a good argument for the bearish case. How you have to navigate that? That's a bit of the challenge here. So again, focus on the short term for right now, manage your risk, continue to hold a little bit of extra cash, and as the market begins to tell us more about what it wants to do, we'll change our allocation models from there. That's 3 Minutes on Markets and Money. See you back here tomorrow.